Hi, everybody. Thank you for joining another Rocket Dollar webinar. Today we have an expert in the field of private equity and venture capital investing joining us. Um, Hopefully I didn't pigeonhole you there, John. I know you've done a lot of other things in your background, but that's probably the closest thing I could come up with. So for those people that are new joining this webinar for the first time, the Rocket Dollar webinars are meant to provide awareness of the different investment opportunities and offerings across the various different asset classes. Um, Presentations themselves are not meant to be a solicitation, only educational and informative. Obviously, we ask that all investors do their own due diligence before making a commitment to an investment, as they do have the opportunity for potential growth and losses. So with that, John, we are very excited to have OneFund here today, and glad you could spend some time with us, especially with the company that you co-founded. And lastly, just so everybody knows, even though this is a presentation to a wide audience, only accredited investors are able to invest into the OneFund opportunities. All right, John, so tell us a little about what's going on at OneFund.
Yeah, Nick, thanks for the introduction. It's too kind. And obviously super happy to be here, and we've been thrilled with our partnership with Rocket Dollar so far. So it's nice to finally get to do one of these webinars. I've watched a few of them so far, and they're all great. So as Nick said, OneFund is a platform that allows everyday investors to get access to top tier private equity and venture capital investments as a way to diversify their portfolio and get access, honestly, to a very exclusive asset class. I think for decades, private equity has been kind of the most coveted asset class, really historically strongly performing and consistent over time, but just not available to most individuals. I started my career at a firm called General Atlantic, which is a big growth equity fund based out of New York. And what always struck me there was it's an amazing firm. They do a lot of really amazing things. But, at a firm like that, the minimum investment is like 10, $20 million, right? So it's probably inaccessible to anybody who's not an ultra high net worth individual or an institution. And so while I was working there, it was just kind of like, hey, like this doesn't feel right. Not only is it inaccessible, but it takes a team of people to diligence these funds once you find one you like and they say, hey, you're allowed to invest. And so unless you really have that institutional knowledge, access, and capital, it's just very hard to get into these opportunities. And so I was chatting with my friend and co-founder Spencer, and he was working as the co-head of investor relations at a hedge fund, and he was like, yeah, like I'm also having that issue. And so we decided, hey, let's found OneFund and really make an opportunity, right? A highly curated platform where people can go and see, not 100 different opportunities, but, two, three, four, vetted, diligenced opportunities that are available to people at lower minimums. So we work with VC and private equity funds that are all vetted, have track records, anywhere from $50 million AUM emerging managers to multi-billion dollar name brand funds. So it's been a really, really fun journey. And we're really excited to be giving more people access to this sort of stuff.
That's great. And I feel like our two companies have a lot in common with that. Our approach is trying to provide access to these different opportunities at an affordable price point, right? So if you look at some of our competitors, having a self-directed IRA or a solo 401k in some circumstances is cost prohibitive, right? Whereas there are a few other companies that do have competitive pricing, but what you were saying about having these $20 million minimums, I mean, a lot of investors are looking for, I mean, not just to put one whole chunk of money into it, but trying to diversify, right? So if you have a lower price point, even at 100,000, you can start to do a little bit more and spread the money around, right?
It's interesting. I was having a conversation with someone who's very senior at a fund, who works in investor relations, so fundraising basically for their next funds. And there's desire out there from these funds to get more people, quote unquote, retail investors onboarded, but they just don't know how, right? Because you need to have the technology, you need to have the distribution
Right.
channels. they just don't have. And honestly, they probably shouldn't be doing it. I have a fundamental belief that a VC or PE fund can't be great unless they're focusing on investing. But he was like, oh, yeah, we're moving more retail. We just lowered our minimums from $20 million to $5 million. And I was like, okay, like that's great, but I wouldn't exactly call $5 million like mass accessible. So there's a desire out there to do this stuff. What they need is those technological partners and those distribution channels to help make it possible. But there's been some, what we came here to talk about today, right? Kind of capitalizing on change, and I think this is part of that change that's happening in the PE and VC industry right now, getting more people involved. But over the past few years, there's been a lot of really interesting changes that have happened in the private equity venture capital industry that are, I think, very important, for anybody on the call who's looking at PE or VC, thinking about making an investment. There's a bunch of different trends that have been going on that we'll talk about later that I think are really important to keep in mind as an investor in these funds, whether it's increasing interest rates, increasing levels of dry powder, ESG considerations. And part of that is all what makes investing in PE and VC very complicated, right? It's not like just going and buying a stock on the stock market that does all these SEC filings and you kind of exactly what you're getting. These funds are really unique, really bespoke. And part of what we're trying to do at OneFund is things like this, right? And give information to people that helps make those decisions easier, right? And kind of peels back the curtain a little bit on how these decisions end up getting made.
Yeah, and I noticed that your website has like a private equity 101 portion of it, right? So I guess if you register, you can get access to a newsletter.
Yeah, so we have a new article series that we just launched, PE 101. The goal of it being to help educate people, take sort of like complex topics, whether it's about the J curve or capital calls and things like that, and really condense it down into just a few paragraphs. It's like, hey, if you're interested in investing in PEVC, here's what you need to know. We publish those bi-weekly. People can sign up for our waitlist on our website and get access to that, as well as our newsletter.
Awesome. So I guess let's just talk about what the fund selection process looks like, because obviously you're no stranger to investment selection, right? So how do you guys go through and say, okay, we want to get XYZ fund on our platform?
Yeah, that's a great question. And I can answer that, and then maybe we can transition into, the capitalizing on change portion, right? And some of the different things that are going on in the P and VC industry, because those changes as well are really, really important to the whole fund selection process,
Excellent.
whether it's for us at OneFund, but also for, listeners when they're thinking about what fund do they actually want to end up subscribing to on a platform. So we look at 4 key areas when we're diligencing. First is the management company. So, the company itself, what's their history? What does their team look like? How consistent has their team been? At the end of the day, these funds are really driven by like the key deal makers. So who are those deal makers? Have they been with the firm for a long time? And are they going to continue to be with the firm for the next fund? And then also, who's the limited partner base? Who are the people that are giving the fund money? You want to see a good combination of institutional investors as well as individuals. If you know that, hey, Harvard Management Company, the California State Pension Plan, the New York Firefighters Pension Plan are giving money to these funds, it de-risks it a little bit because that they've run a very stringent due diligence process. The other is we look at the fund itself that they're raising, right? Like what's their past performance? What's the strategy of the fund and their track record? And also really importantly, like back to my comment earlier, it's all about team. You really want to look at what we call deal attribution. So not just what deals were made, but who made them. If they had a bunch of home runs, but the deal maker for that left the firm 2 years ago, it's a little bit riskier than if that core person is still with the firm. The investment process, who has final approval. One thing that we're looking at more and more, and can talk about this in a second, but it's how are deals won other than price? So when the PE or VC firm is actually like trying to make an investment in a company, oftentimes for these really, really hot deals, they have to compete to get an allocation into the round. And so how are they winning those deals? If they're winning those deals by paying more, that hurts your returns as an LP and an investor in the fund. But if they're winning those deals because they have a really, really great brand name, like Andreessen Horowitz, for example, and they're able to get in because people want them as an investor so bad, or if they're winning the deal because they have a really, really great operating team, like OpenView Partners, for example, and people want to work with those teams, that is a really positive sign. And then lastly, their operational capabilities. What do they do to help their portfolio companies other than just providing capital? And really, how measurable is that impact? But I think maybe it's a good time to transition over to the, kind of like the main part of what we're here to talk today about, which is all the different changes that are happening in the private equity and venture capital market. Because while those like four things that I listed are really important consistently, there's a lot going on right now that when you're looking at a different VC or PE fund that you want to have in mind as you're looking at making that investment decision. And over the past few years, it's been extremely, extremely dynamic for the PE VC landscape. You look maybe like 5-10 years ago, there were kind of like low to moderate levels of dry powder. That means like the money that VC and PE funds kind of had in their war chest to invest was at a much lower level than it is today. There were near 0% interest rates. You kind of had like a singular profit motive driving all investments, and that's still the main motive today, but there's quite a few other considerations that people are thinking about. Shareholders were kind of the only key stakeholder. And a lot of the returns were driven through financial engineering and capital. But as we think about how things look today, you've had like really record levels of dry capital. So right now in the US or in the US, there's $3.7 trillion of capital sitting on the sidelines. So like PE and VC funds have more money than ever to deploy, but they're also being more cautious than ever. As interest rates have been rising, deal making has really slowed down. So there's a big question of like, what's going to happen with this money, right? Interest rates are a lot higher, which is making it more challenging if you're a buyout fund, for example. And there's been sort of massive levels of capital flowing into like impact funds and ESG considerations as well. So just a lot of really significant changes that have been going on over the past year. So if we look at that first one, right, the $3.7 trillion in dry powder that's sitting there, you can see how it kind of has this like hockey stick curve, right, as you go closer to the current day. If you just go back 10 years ago, right, there's about $1 trillion of dry powder sitting around. And you might call that a kind of healthy level, right? Like you need a bit of dry powder, money in the war chest, so that when a PE fund finds a good deal, they can go in and deploy that and generate a return for their LPs. But over the past few years, it's really, really, really accelerated. Part of this is kind of driven by, the very, very low interest rates. People have been able to borrow and give that money to private equity and venture capital funds. And then part of it in recent years has been that deal making has just slowed down a lot, right? As the economy has kind of slowed down, firms are a little bit more hesitant to deploy capital. And there's a lot of different implications that this can have for the market that investors should kind of be thinking of. The first is that there's going to be increased competition for deals. As PE and VC funds are looking to deploy capital, there's more capital going around right now. It's not being spent, but eventually it has to be, right? And there's going to be increased pressure from LPs to deploy that capital. If you've given, $50,000, $100,000 to a PE fund, you don't want to have them just sit on it, right? You want them to deploy it and start generating a return for you. And this can put some price pressure. If there's a lot of money and people have pressure to spend it, PE and VC funds could face pressure to pay more than they otherwise would. We're not really seeing that right now. Fortunately, there's still a lot of discipline, and multiples have gone down over the past year as the economy slowed. But it's something to kind of keep in mind, right? When you're looking at a fund, do they have a ton of dry powder that they're looking to deploy? Are they going to be spending it and deploying it in kind of a careful and measured manner?
So, given the characteristics of the current market, would you consider right now to be a good or bad time to put forward some of the investment into venture capital and private equity?
Yeah, that's a wonderful question. And look, there's you can time cost or dollar cost average it right over
Hmm.
like a long period of time. But if you look back historically, there's always cautions not to invest, right? And you need to pay attention to those, right? And maybe be judicious about where you deploy capital. But if you look back at the vintages that have performed best over the past 20, 25 years, call it, you have 2001 and you have 2009, 2010. So it's those periods right after a dip in the economy that deployed
Hmm.
capital ended up generating the highest returns in PE and VC. Technically there was a recession, right? There was negative
Right.
growth in negative GDP growth in 2 quarters. For
Hmm.
some reason, we didn't call it a recession, but by every measure that we have, it was. Timing the market is always dangerous, but if you think about how PE has performed historically, you can make a very strong argument that now is a really, really attractive time. And we can
Hmm.
get into this later. I think that all of these different components that we're going to talk through are things to be aware of, right? When you're looking at a PE or VC fund, if they have a massive war chest of capital that needs to be deployed, maybe wait for their next fund, right? Wait until
Hmm.
they've deployed that and they have some of that pressure wearing off. I mean, I'm investing my own money right now, and I personally feel like it's a good time.
Thanks.
And then that other component that's top of mind for everyone, right, is increasing interest rates. We've lived in a 0% interest rate time for so long. Having to adjust to this new normal is a little tricky, right? One of the ways that buyout funds, especially, so if you think about sort of like the umbrella of private equity, right? On the very early stage, you have VC. On the very late stage, you have buyout. And one of the ways that buyout funds spend money is they use a lot of leverage. They take out a lot of debt and they buy companies and they use that to juice their returns. It's going to get harder to use leverage. It's getting harder to use leverage. Like there's no sign on the horizon that Jerome Powell has interest in stopping increasing rates, especially
Hmm.
as the economy starts to heat up again. Um, and also, this has impact on tech multiples. As interest rates go up, tech especially sees its multiples decline, right? As future cash flows have to be discounted back. And this combination of like less cash and lower valuations can make things particularly challenging for certain strategies that rely on more cash and ever increasing valuations. And so buyout could see themselves have a little bit of pressure as well as tech. And exit strategies start to get weird too, right?
Hmm.
When a PE fund is looking to sell their portfolio company, how do you think about that as multiples are decreasing and people have less leverage to deploy? So overall, there's just sort of increased uncertainty. The way that we kind of conceptualize this on our side is looking for funds who have been able to generate strong returns without leverage, because leverage is going to be harder to come by. Funds who have existed in a time when there wasn't 0% interest rates, right? So funds who were generating strong returns before 2008, and funds that just have broader exposure, either not necessarily to sectors other than tech, but they're not betting on these moonshots, right? They're betting on companies that have solid fundamentals already today.
Right.
Another thing that's been really interesting is this sort of like growing capital flows to impact funds. Um, and this has been very, very, very interesting to watch, right? Over the last few years, you just see a ton of money flowing to funds that are investing under various social causes, right? Either in green energy, underrepresented founders, and a lot of these funds have performed quite well. A lot of these funds have not. And so I think the thing here that we're seeing is like exercise caution when you're looking at impact funds. We don't shy away from impact funds, but there's also different diligence when you're considering investing, giving your money to an impact fund. There's different things to consider. And the biggest one that we consider is, okay, are they an impact fund because they have a competitive advantage in this space? Or are they an impact fund because it's really trendy right now and they think they can raise a lot of money doing it? We have no problem putting funds on the platform who have a strong competitive advantage in a certain field. We like that. Where we start to get nervous is where funds are kind of, putting constraints on what they can invest in because of an arbitrary mandate that they have to be an impact fund. You can't optimize two things perfectly at the same time, right? If you're trying to optimize for profit and return, you can try to optimize that as best you can. But once you say, hey, we're trying to optimize return, but we're also trying to optimize impact, one of those has to have a little bit of give, which isn't a bad thing, right? But I think as investors, you need to ask yourself, what am I trying to optimize? If I want to try to get return and do social good, these funds are a really, really great opportunity. But I worry sometimes there's a lot of research that goes either way, right? Oh, impact funds have higher returns. Oh, impact funds have lower returns. But there can be a lot of smoke in mirrors. So I think with impact funds, there are some really great ones out there, but it's a little bit of buyer beware. And the question is, why are they an impact fund? What's their competitive advantage there?
Those are very good points, and that's one of the dilemmas I've always had. Because you don't often see the returns translate with an impact fund that you would in a different type of fund, right? A fund that's not an impact fund.
Yeah, and it's just it's a law of physics, right? You can't
Hmm.
optimize two things simultaneously, and that's fine. But as an investor, you need to ask yourself, am I okay with that?
Right.
And oftentimes the answer is yes, but oftentimes, you want to optimize one or the other, right? You can invest your money or you can donate it.
That's
And if
yeah,
you want to feel like you're doing both at the same time, there's going to be a little bit of trade-off, and that's not a bad thing. It's just it's oftentimes reality.
right.
And that kind of ties into the next thing, right? Which are like different ESG considerations that are coming up a lot right now in the PE and VC space. So ESG is environmental, social, and governance, which has really taken the forefront over the last few years, right? And it's this idea that, hey, look, previously the only stakeholders we needed to care about were the shareholders. They were the ultimate ones that all decisions need to be based around. And ESG has kind of gained a lot of momentum as a philosophy in the business world and said, no, look, there are other stakeholders that you should be trying to care about, right? There's the environment, there's the workers, there's the society that you live in, right? And thinking through how you run a company that balances that has become a lot more important to a lot of people. The Bain did a survey of several hundred limited partners in private equity and venture capital funds, and they found that 93% of limited partners would walk away from opportunities that didn't take ESG seriously. Most top PE and VC funds nowadays have people who are a large part of their job is ESG, if not dedicated solely to ESG, because LPs clearly care about it. 50% cited better investment performance as a key reason to incorporate ESG. I think, kind of what we were talking about before, right? It's difficult to optimize two things at once. But one thing that is very legitimate here that might be leading to that is that nowadays there is a lot of risk to you if you do not take ESG seriously. And managing that risk is really, really, really important. And so having that be, when we look at funds, we look at where do they stand from an ESG standpoint. Because if a fund, if we put a VC fund on our platform and they make a big bet on a company, and turns out that company is horrible for the environment, knew they were horrible for the environment, and was doing nothing about it, nowadays their valuation can get crushed, and the returns of people who invested in the fund can be very poor because of
Mhm.
that. So one of the things that we really look at is, what do their ESG processes look like? Are they looking at ESG when they're making investment decisions? And you can see kind of on the right side of this slide, a ton of companies have sprung up because of ESG to kind of help people think through it. There's tons of data providers now that help people think through ESG investment decisions. Similar to, when you buy people may not have noticed this, but when you buy an electronic item, there's a little stamp on the back labeled UL, Underwriters Labs. And that's like, hey, this company has certified that, this laptop isn't going to like blow up basically or catch on fire. There are companies now who do that, for ratings companies that do that now for ESG. They'll look at a company and, measure out its carbon footprint, its social impact, and give it a score. EcoVadis is a really great company that does that. And there are a lot of funds and consulting companies that have sprung up. It's a very, very new field, and so it's tough to say how resilient all of these companies will be going forward. But a lot of them have had a ton of explosive growth, and LPs are increasingly caring about ESG. And then the last thing that I had that I wanted to discuss is some of like the big changes that are happening right now in the PE and VC world, is operating teams. This is kind of like a little known facet that exists in the PE and VC world, but it's growing really, really, really rapidly. And so you have, a PE and VC shop runs on its investors, people sourcing new deals to make, making those deals, and then selling those companies later on. But what's become increasingly popular are these operating teams who actually go in and try to help improve the performance of the companies that they work with. There used to be a time where giving capital was enough to generate a return. But nowadays, people are looking for more. Is the level of dry capital is increasing, capital is getting a little bit commoditized. And so having a way to stand out by saying, hey, look, there's more that we do here is really, really, really important. And there's a ton of different models, and not every firm goes with one model over the other. Some do a combination of both. But essentially, the three different models, you have this like operating partner model where they'll have a bunch of really successful, old, white-haired CEOs, former CEOs who will go in and kind of advise the portfolio companies on how to operate. You have some companies, KKR Capstone is a really great example of this, where KKR has their own consulting firm called KKR Capstone that consults exclusively for their portfolio companies. And then, the other extreme of kind of the first model that I mentioned is you'll have these integrated operating teams. So these teams that will go in, they work for the PE or VC fund, but they'll go in and advise and do projects with the different companies in the portfolio. And this really helps grow returns in kind of two ways. I mean, I think the first is obvious, right? In that you are accelerating the growth of the companies that you invest in. But the second is it helps win deals. This is, like I said before, one of those things that we look at. How does a PE or VC firm win deals other than just competing on price? And one of those ways is by saying, look, we have this team that we can help you grow and command a higher valuation in your next round. This to us is like a very important thing that we look at when we're looking at a fund. Do they have this team?
That's super insightful. We had a question come in, and I wanted to tie this into another question that I had. It's mostly around liquidity. So we have obviously a lot of different investors from all walks of experience. Lately, we had a lot of real estate investors come to the platform, and real estate, you typically we hold it anywhere from 5 to 7, maybe more than 10 years, right? So if we could
Mm-hmm.
have a bit of a comparison with maybe um, having fund as a component to maybe a real estate asset, and what kind of liquidity does it have? Is there a set time period until the investment matures, or is there liquidity events all along the while?
Yeah, no, that's a great question. And there's actually a slide in the appendix I can flip to in a minute that I think discusses this fairly well. I'm of the point of view that you should have a well diversified portfolio. I think real estate and private equity are investing in two very distinct different asset classes that are relatively uncorrelated with each other. And having both of them is really important. Most people, most people who own a home are really over indexed to real estate without realizing it if you have, a quarter of your net worth tied up in your house. Um, and most people are not overexposed to private equity or venture capital. If you take a look at like university endowments, they typically allocate about 15% of their endowment to private equity and venture capital. Most Americans are not there. One of the reasons why universities that only have 15% allocated to PE and VC, despite the fact that it performs so well, is exactly what you just said earlier, right? Around liquidity. Private equity and venture capital is highly illiquid. Your capital's is typically tied up for at least 5 years. One thing we're working on the engineering side right now is building up a trading platform where an individual can trade their stake in a fund with another member on the platform, and you can get liquidity that way. It's not live yet. We're very, very, very excited about it though, and I think it's going to make things a lot easier for people. Yeah, that's one of the drawbacks today, and I think there's some really exciting solutions out there that are trying to solve it. When I said I had a slide in the appendix that I thought could be helpful, this is it. So this is some research that Fidelity did that I think is like really, really, really interesting and kind of speaks for itself. They were looking at the impact of owning alternative investments versus kind of like traditional assets on a portfolio. And so you can see real estate is kind of right in the middle, maybe the lower right, 25% volatility, roughly 10 to 11% returns over the time frame that they measured. Whereas buyout private equity, a little bit higher to the right, actually lower volatility and higher returns. But the real magic comes from combining them all together. So that's one of the reasons why we're a big proponent of diversifying. If you take a look at that gray line, that's kind of your your risk return profile if you have traditional asset classes. So that being, treasuries, public equities, stock markets, etc. Once you start incorporating in alternative asset classes, your risk return profile goes up to that green line. So essentially, for the same measure of risk, you actually get a higher return by incorporating in buyout, real estate, venture capital into your portfolio. Just as they're relatively uncorrelated assets, and over the long term, there's a really, really huge benefit to that.
So you mentioned that you're looking at some of the more interesting type of investments. What have you seen recently that have caught your eye?
It's been a very interesting time to be an investor in VC and PE funds. Like I said before, we're very excited about the timing right now. Just seeing how 2001, 2009, 2010 vintages performed so well. What I'll say is that some VC funds are honestly having trouble raising their current rounds, which we view as a good thing. They're over, from 2010 to 2020, there was just this kind of unfiltered proliferation of VC funds because money was cheap and valuations kept rising. I think we're going to see a lot of VC funds have some trouble. So that's been very, very, very interesting. But what we do have a lot of faith in is there are some emerging managers that come from truly strong teams that we think will be in a good spot because they're going to be differentiated, right? a lot of emerging managers kind of rode this wave and valuations going up and up and interest rates being extremely low. And so there's been quite a few emerging managers that we've had our eye on that have been very, very interesting. The other thing that I've continuously been bullish on personally is growth. It's a lot of tech, but it's not necessarily all tech, and they don't use a lot of leverage. So that risk of interest rates increasing is mitigated a little bit there versus say a Warburg Pincus that does a lot of tech buyout, right? Like tech buyout is like
Right.
the worst position to be in when interest rates are rising. A lot of buyout shops are probably going to have some problems as rates continue to increase.
Gotcha. Any additional questions, please put them in the Q&A now, and we'll wait for a little bit. Otherwise, you can get in touch with us directly. We'll be happy to answer all of your retirement questions at Rocket Dollar, and John and his team can take all of the questions that are specific to OneFund. All right. Well, just wanted to say thank you, everybody, for. Oh, we had one more slide in here. I believe that question was answered earlier. It was about how OneFund finds funds to invest with. Yeah, we did answer that question earlier in the presentation. There's 4 different, I guess, metrics that OneFund uses, right? So if you don't mind, we can maybe save that one for another time. We can position the
Yeah,
recording.
and also I think it could be like, how do we get in touch with funds? How do we get
Oh,
allocations?
okay.
And Spencer and I, my co-founder, we've worked in the industry um, for a while, and we have a lot of contacts that we've been able to leverage. And also, we look at dozens of funds before approving one to go on the platform as well. And so there's a really robust pipeline of funds that we're looking at before we end up putting anything on the platform. Is sort of our process internally.
Okay. Well, thanks for jumping on that. And then Joe sent a question. Can you unpack some simple things in the PE space like LBO versus platform versus growth?
Absolutely, and Joe, that's probably a good idea for our upcoming, some PE 101 articles. So in terms of, LBO is a leverage buyout. That means that a PE fund is using debt in order to acquire their company. So, something to kind of keep in mind as interest rates are rising. A growth equity fund kind of sits in that middle ground between a VC fund and a private equity fund. So they're not investing quite at the earliest stages, but they're investing in companies that still have really solid growth, but they kind of found product market fit and they're on their way to be the next unicorn. And then VC and PE, what I talked about before, they kind of just sit on like opposite sides of this umbrella, right, of private market investing. VC is going in at sort of like your pre-seed stage, your seed stage. Normally, it's a lot riskier but higher upside, versus buyout, which is going in buying very mature companies, typically using debt, a little bit less risk, a little bit less return, typically.
All right. Well, thanks for asking. Yes, thanks for asking that question, Joe. And again, if there are any other questions out there, just wait for a little bit longer. I don't see any more coming in. No, I guess that's it. And John, thank you very much for joining us. That was incredibly informative about the VC and PE space, especially during what we're going through right now and the heating up inflationary period. But if anybody wants to get a hold of us, we do have the information in the chat, and we'll be sure to reach out to you following this presentation. All right.